My experience is it's much more idiosyncratic and based on serendipity, and my story is no different. I came out of business school with a background in investment banking and strategy consulting and a passion for technology. I was living in New York. The year was 2000, and Silicon Alley was just starting. And for me, the most interesting thing I could do was to get onto the venture side and help build the companies and build the ecosystem. And I was incredibly fortunate to offer a position at one of the first venture firms / incubators. So I worked in the very beginning days with Albert Wenger, who then, of course, went on to Union Square fame. Well, post being in venture on the direct side, I moved to California and was fortunate enough to work for Pierre Midyar in a Midyar network. And I was on the investing team. And in that firm at that time, I don't know if it still is true, this was back over a decade ago, the investing team had to do both direct, indirect, and nonprofit grants. Every year, like you had a mandate, and that's what you did. So that was my first exposure to the indirect side, and I discovered that I really loved it. And while I enjoyed the direct side, I just had a stronger passion for the indirect. Well, Sapphire Ventures today is an independent firm, and the money originally came from SAP. And what we've done on the indirect side for our LP vehicle is convert that into an evergreen vehicle. So we are able to take the money in. We're not fundraising. The goal is to never fundraise again and just recycle the capital through the proceeds from our managers into future commitments. The growth fund, which is currently investing a $650 million vehicle, does raise every 3 to 4 years and historically has raised from SAP, and they're currently investing their second fund. Yeah, we've tried to create a very harmonious universe in the Sapphire world, so both the direct team and the indirect team, we have the appropriate divisions between the two. We have separate investment committees. We sit together, but we have different, investment diligence sessions as well. But at the same time, there's a lot of shared understanding and awareness. And when we are looking at, say, a fund, for example, if there's some up-and-coming companies that the fund we're looking at would like us to make introductions to our growth team, we do that. And at the same time, we can pull from the intelligence from our growth team that's looked at other companies historically and get smarter faster on what's going on in the ecosystem that way. And vice versa, when the growth team is trying to get smart on a new space, they can speak to our general partners who may be already making some new investments in a new area, and we can cross-share that way. It's always through introductions and through you want to be appropriate and maintain the right confidences. But if you ask people, would you be interested in speaking to someone who has a large checkbook that can write a $15 million or $20 million check into one of your companies, that can work out very well. It's also why we do only early stage venture funds in our indirect portfolio so that we can keep the sort of positive cycle going on it versus creating conflict. We will be managing about $1 billion of assets under management once the complete cycle of the evergreen vehicle kicks in, because you have to pull money down every year and give it a fair bit of incubation time right before the proceeds come back. And we have probably a baker's dozen of core managers that we work with, and we invest in, and it's predominantly Series A exposure that we work with in the US, Israel, and Europe, and the majority of the dollars and the managers are in the Bay Area, but we do have an international perspective. Our program is only 5 years old, so what we're looking to do is be conscious of the dynamics in the industry. And one of the very clear dynamics is the emergence of new and exciting managers on a pretty consistent basis, and the important role that they play in the health of the industry. So we want to build a platform that could both work with established and emerging managers, and that also means being able to add new managers on a consistent annual basis. So every year we've added some new ones. It varies how many, again, based on any given year. If we don't see something we want to do, we don't, but if we do, we can. Focused on IT. We've spent a significant portion of last year doing a deep internal research dive on the healthcare space to look at doing allocations into healthcare funds, and we're considering that for this year. But historically, we've allowed the healthcare to come out as a byproduct of our GPs in the IT space pushing into some of the digital health categories. Very much a back to basics kind of people, and we do a lot of understanding around the financial construction of their deals and trying to understand when looking at someone's portfolio, when was the first initial investment done, what happened after that, were there follow-ons, what were the check sizes, what was their thinking. Because as an LP, what you want to do is just understand the people that you're investing in. But our market development team puts together a series of events and makes a number of business development connections. They do a couple hundred over the last 2 years for our portfolio companies. And part of our diligence, again, in understanding the portfolio of our GPs is seeing how we can then actually provide value ourselves. It's also quite helpful to be able to the same extent that entrepreneurs try to get to know the GPs in advance, doing whatever homework you can do on the LPs as well, because sometimes you find that the LPs just aren't investing in the sector. Like you get people pitching you, and we don't do private equity. So when people send me decks for that, it's I feel badly, right? It's just not helpful because there's nothing I can do. So people can shorten their process a bit by understanding in advance, and it's hard to find information on LPs. A lot of folks don't put a lot of information out there. We're hoping that help and trying to help change that. But to the extent they can ask other LPs for introductions and figure out how to get to the people they want, that can move things forward a lot. For people spinning out of other funds, one of the things that I've also found that seems to be compelling to the market is if they can get some of if you're in Fund A and you're going to start a new fund, if any of your existing LPs will come with you and help anchor your fund, that can really accelerate fundraising on your behalf. That seems to be a method GPs use quite successfully. Turnoffs on things that we've seen, well, when people haven't done their homework on understanding the competitors in their space, that can be a real turnoff. Especially in the Bay Area, the likelihood that you're the only person investing in a space is just very low. It's important to be conscious of what you do in the world and how you can act as a role model, and that's sort of on all levels, right? That's not necessarily how you invest, but how you move through the space and what you can do to be helpful and additive to others. That said, I don't think we don't invest with a specific mandate on any sort of gender basis. We don't try to do men or women or anything else. We try to invest in the best funds, and I think best funds, all the statistics show in public markets and in public companies, the greater the diversity is, the better the company does, right? And on the board representation, other areas at executives. So one would believe that is true both in the startup world and in the venture world. I don't see any research that argues otherwise. So one would believe that if diversity is well managed and well represented, it should produce good results. So you're conscious of that as an LP, but again, you're looking to invest in the best funds. You don't have a quota on specific demographic targets.